When it comes to investing, starting out can be scary, and more often than not, you have to learn from your own mistakes. Learning from mistakes can be extremely difficult because mistakes in the stock market can and will cost you money. So I've put together a list of rules you can remember as you invest and gain more confidence over the course of your investing journey. Experienced investors know these rules for investing, and now you will know them too. If you enjoy this sort of content and want to see more videos like this in the future, please give this video a thumbs up so YouTube can recommend it to other viewers, and please subscribe to support the channel. Before we continue, I have to state this video is for educational purposes only and does not constitute any financial or investment advice of any kind. I am not registered to provide investment advice. If you are looking for financial or investment advice, please contact a registered professional. Rule number 1. Bulls, bears, and pigs get fat, but hogs get slaughtered. When it comes to the stock market, money can be made regardless of the market conditions. Money can be made in a bull market, bear market, or flat market. Here is a quick refresher for the terms that were used. A market that is consistently rising is considered a bull market. A market that is consistently falling is considered a bear market. And a market that is not increasing or decreasing is a flat market. As an investor, you can make money in any kind of market, but it helps to not be overly greedy. Sometimes it's worth taking your winnings and leaving the market before your winnings become losses. Rule number 2. Invest with your head, not with your heart. The honest truth is, the stock market does not care how you feel. The stock market doesn't care how anyone feels. It is difficult to do, but if you remove emotion from your investing process, you will have a lot more success. Let's say right now one of the companies you invested into isn't doing well in the market. Can you confirm if 1 year from now that company will be in the same position? How about 5 years? What about 10 years? You do not know what will happen. Pulling your money out at the slightest dip will confirm your losses and you will lose out on potential future gains. Often, it helps to invest into strong companies that you believe have potential for growth and companies that you expect to be around for a long time. Rule number 3. Consider market leaders. They are expensive, but worth it. The stock market is made up of multiple sectors, and each sector has its own market leaders. The quickest way to find some market leader companies is to look at the Dow Jones Industrial Average Index. The Dow is made up of 30 large companies that encompass multiple sectors of the stock market. If you are interested in the food industry, according to the Dow, one of the market leaders is McDonald's. McDonald's stock trades at over $200 and it is more expensive than other companies in the food industry. But, as a market leader and a globally recognized name, generally, McDonald's can be considered a safer investment than purchasing shares in a new company that is trying to break out into the food industry sector. There is always the possibility of something happening to McDonald's, and its stock price can fall. But McDonald's has a reputation of being a market leader. It is a company that is recognized on a global level. McDonald's is consistently profitable during good times and bad times, and McDonald's pays a dividend that has consistently grown over the years. Market leaders can give your portfolio some sense of security. Don't forget to consider them when investing. Rule number 4. Buy damaged stocks, not damaged companies. The stock price doesn't determine the health of a company. There are multiple factors that can cause a stock price to drop, from different management being named, a new competitor rising in the market, or even a black swan event like we saw in 2020. But when there is a massive sell-off in the market, the stock price of good companies will be damaged. If a company's stock price is damaged due to reasons outside of the company or mere speculation, the reduction in price can be viewed as an opportune moment to purchase shares. You can consider the stock to be on sale, and when the market returns to normal, the stock price of strong companies will return to their previous levels. As a result, your portfolio will grow because you purchase shares at a reduced price. Rule number 5. Put eggs in multiple baskets. Mitigate risk through diversification. When it comes to investing, you shouldn't rely on only the stock market. If you only rely on the stock market, you will put an immense amount of risk on your portfolio. There are safer investments that you can make, such as putting your money into a CD, purchasing land or property to rent out, and even purchasing bonds. Now this is difficult to do when you are young and don't have a lot of money. You might have a little bit of money and your only form of investing might be the stock market. If that is the case, then you can consider diversifying within your stock market portfolio. To diversify your stock market portfolio, you can invest into ETFs, index funds, blue chip stocks, growth stocks, and REITs, to name a few methods. Investing into index funds, such as the S&P 500, will give your portfolio small incremental growth for many years. The blue chip stocks and REITs can give you passive income from dividends, and the growth stocks can add a little bit of risk in your portfolio, but can pay off nicely if you choose undervalued companies or companies that might make it big in the future. You can also consider diversifying your stock market portfolio across multiple sectors, so you are not reliant on only a few industries. Rule number 6. Corrections are inevitable. A correction is said to have taken place when the overall price of a security drops by 10% or more. Corrections can be caused by a plethora of reasons, from large-scale macroeconomic shifts to problems in a single company's management plan. Corrections can happen, have happened, and will happen again in the future. But if you remember rule number 4, buy damaged stocks, not damaged companies, you can come out ahead during a correction. If the stock price of a company drops by 10%, this is equivalent to a sale, as long as the company you like to invest into has strong fundamentals and a bright future. A correction is nothing more than a sale. During a correction, you can purchase more shares of your favorite companies. Over the long haul, those shares will pay off when the market begins to climb again. But remember, corrections could be the start of something larger, such as the beginning of a decline for a company. Understand a company, understand the risk associated with investing during a correction, and make the best decisions that work for you. Rule number 7. Stay within your circle of competence. Invest in what you know. Regardless of what companies you choose to invest into, your money will be at risk, but it helps immensely to know what you are investing into. When you invest in the stock market, you are purchasing shares of companies. As an investor, you might be looking for long-term growth with the least amount of risk, so ask yourself, what industry do I understand? If you are tech-savvy and are aware of new hardware and software coming to the consumer market, you might be better suited to invest into the technology sector. If you work in the medical field and stay up to date with new medications and advancements of medical technology, then you might be better suited to invest into pharmaceutical companies or companies that create technology for hospitals. Your circle of competence is based on what you know, what you understand, and what you love to learn about. You can always grow your circle of competence, and you should always strive to do just that. If you are new to investing, your circle of competence is a great place to start. Rule number 8. Attempting to time the market is a mistake. I cannot stress this enough. If you try to time the market, you are playing a very risky game with your money. No one knows what is going to happen tomorrow, next week, next month, or any time from now, and the stock market is not any different. If you try to time the market, hoping to buy when the market goes down, you could be waiting for a long time. You wouldn't know if you are at the start of a bull run or not. You can miss out on great investment opportunities by waiting on the sidelines. Instead of waiting to see what the market does, you could consider dollar cost averaging. Dollar cost averaging is a method investors use to purchase shares of companies where investments are made regularly over a period of time, regardless of the stock price during the time of purchase. Let's say you receive a paycheck every 2 weeks and you allocate $200 for investing. Over the course of a year, you have $5,200 to invest. If there is a stock or set of stocks you'd like to invest into, then you can divvy up the $200 you have from each paycheck and buy into those stocks every 2 weeks. Now the stock price can go up or down over the course of a year, so sometimes you may purchase more shares and sometimes you may purchase less, but overall, you are able to buy into your select stocks at different levels over the course of a year, and you do not have to time the market. Rule number 9. Rome wasn't built in a day. Investing and seeing substantial growth in your portfolio takes time. There is the off chance you could buy into a stock and the price begins to skyrocket, but generally speaking, the process is slow. Often the best approach is to invest consistently and remain patient. When you invest, it helps to consider not needing that money for at least a few years, and every time you invest, each share purchases another puzzle piece to your financial empire. Over your investing journey, you will come across opportunities and setbacks. It helps to take advantage of opportunities and learn from your setbacks. Nothing is guaranteed in the stock market, but at least you are giving yourself an opportunity to grow and learn. As time passes, you will get better at investing and more confident in your own abilities. That is when you will truly start to see changes in your portfolio, and you will build towards your definition of financial success. Rule number 10. Be fearful when others are greedy, and be greedy when others are fearful. This might be the most famous quote from Warren Buffett. When the market drops and people are scared, that is a perfect time to pick up damaged stocks. But when everyone is pouring their money into a company, it pays to have a healthy sense of skepticism. Normally, if your barber, parents, mailman, and friends that don't know anything about the stock market start talking about a specific stock, it might be a good idea to leave that stock alone. The largest growth in a stock happens when you are an early adopter and no one is talking about the stock. If everyone is talking about a company, inexperienced investors will flock to that stock for a quick buck. In turn, Many people will be hurt when the experienced investors decide it's time to sell their shares. Be mindful of what others are doing and where you are getting your investment information from. These are just 10 rules for investing, and there are many more to consider, but these should be good enough to get someone started. If you enjoyed the video, please give it a thumbs up by hitting that like button, and please subscribe to the channel for more content. Thank you, have a great day, and I'll see you in the next video.